Hey everyone, in today's video, I'm going to talk about the three US dividend stocks that I'm going to be buying in July 2023. If you like this type of content, be sure to hit the thumbs up button for the YouTube algorithm, really helps out the channel, but we're going to jump right into it. As you can see on the screen, the first US dividend stock that I'm buying in July of 2023 is VICI Properties. VICI Properties is a stock that I recently just started nibbling on. I own 20 shares right now, but I really want to build this into a bigger position as long as it stays at an attractive valuation. Before going into some more details about the stock's performed really well over the last 1 year relative to the REIT sector, which is broadly down pretty heavily. VICI's up 5%. Another thing I really like about VICI is through the pandemic, they actually collected 100% of their rent, despite being in an industry that was very harshly hit from the pandemic. So I think that really speaks to the pricing power they have, the quality of the assets, and the necessity of their assets for their tenants to operate their businesses, even with things like online gaming and stuff like that blowing up. These assets are still super important, and their tenants wouldn't be able to operate without them. If we look at the company here, 31 bucks a share, they're going to do about $2 of funds from operations this year, so trading at about 15 to 16 times earnings for this year. And I've talked about this in some other videos, but what I really like about VICI is about 3/4, I believe, of their rent has inflation adjusted increases in it. So you're getting a 5% dividend right now. They've increased that dividend every year since they went public 5 or 6 years ago. And as they continue to get that inflation adjusted increase year over year, they're going to continue to be able to nibble up that dividend tiny bit by tiny bit. And then the other thing is, as interest rates, or if interest rates start ticking down, that's just going to be all incremental margin that they're going to have higher and higher funds from operation. So between potential interest rate tailwinds from here, inflation adjusted rents, and some of the scale that they're trying to derive on their business by getting more and more of their tenants' properties, I think that this company can grow mid to high single digits, both on funds from operations and their dividend. They're already starting at a 5% dividend. So it is a really attractive stock, in my opinion, to start building a position in. I also like the starting 5% dividend on this stock as just like a start of getting your money back and return on your invested capital. So looking at their business a little bit, this is kind of a look at some of their tenants here. You see Caesars has 18 properties with them. They own like Caesars Palace, stuff like that, Venetian, MGM Resorts. As you go down, they have some more regional assets as well that Penn conducts business in, and some other partners that they have. They recently acquired 4 casinos from Pure Casino in Alberta, Canada, in a acquisition and then like a lease take back. So the company who sold them the assets are going to be paying them rent, and they did this at a cap rate of 9-10%, I believe. So it was really attractive returns, adjusted FFO accretiveness from that deal, and they're going to continue to look at doing different types of deals outside of the US or inside the US in different sectors other than casinos. But the fact that they have such a concentrated list of tenants and they've been able to collect 100% of rent since they went public, I think really speaks to the nature of the assets they have and just kind of the business model that they're running. Looking at some of their other trophy assets here, you can kind of see this company, obviously mostly a gaming company in terms of the assets they own, but they also own a retail entertainment venues. They have 4 golf courses that they acquired last year, I believe. They have event space, retail outlets within their casinos, stuff like that. So within their or tenants' businesses, they are a bit diversified, but for the most part, right now, it's really pinned down from those casino assets. You see here some of the brands that they own the real estate behind: Caesars Palace, Venetian, Hard Rock Casino, Horseshoe, Mandalay Bay, the Palazzo, Park MGM, Harrah's. It goes on and on if you want to pause and kind of take a look. But they own a lot of fantastic assets. In terms of on the strip, you get a sense here for how much of the strip they actually own. So they own a lot in the middle, and then down the right side, they own a lot as well. So huge business. I think they are the largest landlord. The other thing as we look at areas for them to grow their funds from operation and dividend. They currently own 27 acres of underdeveloped land in areas of the strip. So that's a big opportunity for them too. Whether they just liquidate that, which I don't think they do, and take that capital that they make, buy a asset that is monetizable, or they buy back shares, or they do whatever. That's value on top of the 15 times funds from operation multiple you're paying that is held within this entity. And then this is just kind of showing them trying to diversify a bit. So they are about 50% in Vegas. And then the other 50%, they're buying assets, both casino and just other types of entertainment assets. We talked about golf courses earlier in other parts of the US. They've talked about having appetite to expand geographically outside of the US, as well as new states in the US, new use cases for real estate. So they still have a long runway of growth. They've talked about amusement parks, stuff like that. So we'll see where all that stuff comes or goes from here, rather. But right now, I think they are at a very fair valuation, if not slightly undervalued, just for the stress test that they went through with COVID, still collecting all of rent, being able to drive funds from operations growth, capital appreciation growth of their stocks on their shares over the last 5 years. So this is one that I don't think I'll put a huge position into it, but I'm excited to build it into a bigger position in my portfolio throughout the month of July. The second stock that I'll be buying more of in July 2023, which is a US dividend stock, is Wyndham Hotel and Resorts. Talked about this one before. It's down a couple percent on the year. We pay about a 2% dividend on this stock. If we look at it long term, you can see the wild ride it had. Right at COVID, it crashed along with all the other hotel stocks as they couldn't really conduct business. Went all the way up to about $90 a share, and since then kind of right-sized back into the 60s. This is a hotel operator. They own a ton of brands. Looking at some of the brands they own, you can kind of see here they're really skewed towards the economy, the mid-scale businesses, and they really are a pure licensing play. They license these franchises to franchisees, and they are the franchisor, so they just collect a percentage of revenue essentially, and they get a bit more of that revenue if it's booked through their system that they run and own the intellectual property behind within the company. But they're really just enabling small business owners, for the most part, within the US to operate economy mid-scale, and in some cases upper mid-scale and upscale resorts. They have some master franchisees in other parts of the world that are in charge of the Wyndham brands in an entire country. On those, the royalty they get is significantly smaller because it's another middleman. But that's really how they've been able to start to grow their presence internationally, and that's another big focus for them that they kind of call out. Just looking at their business, they have almost 850,000 rooms. They're looking at continuing to grow this year over year. They've had some really good momentum over the last number of years. They have 200,000 rooms in their pipeline from a development standpoint. So they'll soon have over 1 million rooms, and each one of those rooms are a profit center. Every night that anyone stays in any one of those rooms, they're getting a little shaving off the top of the price per room that they're paying. Their loyalty membership is really one of the main selling points as to why an existing hotel owner may want to license one of the brands. They get access to over 100 million individuals trying to collect loyalty points and such. So that's a really powerful thing. And as we look at the value equation for franchisees, making sure that their loyalty partnership and loyalty program is continuing to grow, continuing to provide value to end consumers and bring people into the funnel is super important. As we look at some of the other things, lots of these destinations and vacations are just on the highway throughout the US. See, 90% of the locations are drive-to destinations. This was a big soundbite during COVID, where lots of people weren't getting on planes. I think that was part of the story as to why the stock ran up all the way to 90. Lots of people were able to just still do vacations without getting on a plane and traveling across the country. And then heavily mixed to leisure instead of business. I think that use case and that soundbite is still cheered by investors. We saw how volatile business travel could be, and with the new technologies coming up, like Zoom being adopted and other kinds of things that make the need for business travel a bit less and maybe turns into a bit of a want The leisure mix that they have with just end consumers is a really important element of their business. As you'll see on one of the next slides, they do have a very asset-light business model. So much of their EBITDA just goes straight into free cash flow, and then they have nothing to do with it because they're not really a hotel operator. So for the most part, they spend that free cash flow on paying dividends, buying back shares, or doing little tuck-in acquisitions. So it's a really efficient business model and very shareholder-friendly model. In addition to that, they continue to perform pretty well. Obviously, they had a huge dip in 2020, and that's why you're kind of seeing these comps versus 2019. But overall, the business is in a good spot. You see double-digit growth on RevPAR from 2019, globally, 8% growth in the US. So, as you look at that, it's 2023, so that's not phenomenal in the grand scheme of things, but it really does show that they're at least having a really good recovery from the huge dip they had in 2020. They continue to grow net room growth, which is really important just as a fundamental part of the equation of how they grow value for their shareholders. EBITDA, $150 million in the quarter. They make about $600 million a year in EBITDA, so that checks out. And then 57% of that was converted to free cash flow. Usually this is higher, so there's probably some one-time items in there. Looking at how they maximize their shareholder returns through capital allocation, they make sure they have a good balance sheet for starters, try to have total leverage at 3x or less, only 20% in variable rate, so then even as interest rates change, it shouldn't impact their leverage position to a great extent. They invest in their business, so some things they've done recently on this is they've launched a new long stay brand called Echo, also acquired Vienna House, which was just like 50 hotels in Europe under a chain. So they do invest and look for revenue growth and such through high priorities, things that they think will be high return on invested capital moves. And then lastly, what they do a lot of, probably with the majority of their money, is return excess capital to shareholders. You see there, they pay, call it a 35% payout ratio. So a third of the free cash flow that goes through the system goes directly to shareholders every quarter. In addition to that, they do probably use another 20-25% of their capital that they get from free cash flow to buy back shares. So over 50% of the capital that gets created every quarter makes its way to shareholders in one way or another typically. So overall, Wyndham right now has about a $4 EPS estimate for the year, going to grow about 7-8% next year. Looking at the stock here, it's putting it right around a 17 times earnings at this level right here, 17, 18 times, because I think it recently got lifted to 4. So let's call it a high teens earnings multiple. I think that's a fair valuation for the stock. I don't think it's a screaming buy. I'd love to get this one closer to a 15, which would mean the stock would be down at $60. If it was 15 or less than 15, given their asset-light model and how much money they'll spend on share buybacks and returning capital to shareholders, I think that's where this would turn into something I'd push into more aggressively. But I'm going to continue nibbling on it throughout July because I still do think it's a great asset, great business model, great company at a fair price, I'll call it. And the third U.S. dividend stock I am buying in July 2023 is Coca-Cola. So Coca-Cola trading at about $60 a share. This stock pays just over a 3% dividend yield. And what I like about Coca-Cola is its global exposure. So they do operate a big business in the U.S. It's the big chunk of their company, but they're also in tons of countries all around the world, big international business. And over the last year, I kind of like how I'm not buying the stock at an all-time high or anything. It's about 5% down and about 10% down off its highs. So these companies aren't high movers. They don't fly 50% or up 50% down. So whenever you can get them on a dip, as long as you have high conviction in the long-term prospects of the business, they could be attractive buys. I also love how Coca-Cola is a dividend king. So they've increased their dividend for like 55 straight years. So this 3% starting dividend yield, my yield on cost year over year will just go up from here for decades to come. So I like that element as well. Just giving a bit of a longer term view here. We're trading at exactly what the stock was trading right before the pandemic. So stock's essentially flat over the last 3.5 years. So that's another thing. Eventually, I feel like over time these companies compound, they break out. I like the price I'm buying in at relative to its previous stock performance, especially when you look at these guys over the long term. They tend to not stay in the same place for too long and compound value. So I'm partially betting on the history of the company and their ability to create value. Also, the Dividend King status of continuing to increase the distributions to me year over year. And also just they have really, really strong brands. So if we look at some of their businesses here, you'll see some of their assets that they own. They recently acquired Fairlife, Costa Coffee in Europe, Coca-Cola, obviously Fanta, and then some of their more niche brands, Topochino, NutriBoost, Body Armor. They just had a big acquisition there. But lots of these are also in-house grown businesses as well. So you can kind of just get a sense on this business, what they're focused on here, what they're trying to drive on their business. Going into some of their growth strategies, you can see they have over 400 brands. But if you look at the number of brands, not too many of them are global. Think like Sprite, Coca-Cola, Fanta, etc. I'm assuming those would be global. Most of them are regional or local businesses, so really in tune with the local consumers. And then nationally or globally, rather, you'll see the percentage of sales under the Coca-Cola brand, sparkling flavor brand, nutrition, hydration, and emerging styles of business. So they're relatively diversified, as Coca-Cola and soda pops probably decelerate over time in terms of their share of the pie. Looking for some more growth from some of these other areas, whether that's coffee, sports drinks, teas, or nutrition and juices. So it will be interesting to see how it plays out, but they have such a strong footprint across the global beverage market from a distribution standpoint, from a technology standpoint, that I think no matter where consumer preferences move towards, they're going to be at the forefront of being able to win with those consumers and continue to hold and grow their market share in this category of beverages. It's also an item and a product that pretty much everyone in the world needs to drink throughout their life on a relatively consistent basis, especially in the developed world. People are having drinks of one kind or another every day, usually multiple times a day. So it's a very high touch point place to play and huge opportunity if they're able to unlock it. They kind of talk a bit here about their vision as well. So I'll just kind of skim through it. They talk here about creating values for customers and some things they're looking to do across their entire business. Going back up to the top, you can kind of see strategic alignment, driving scale and investment. They have a ton of scale on their business, strong execution, having a winning culture, and that together all creates volume to value growth for the company, for the market, for retailers, etc. If we look at their stock or their earnings per share estimate, they're coming in right at about $2.60. So if I look at their stock here, they're trading right about 23, 24 times this year's earnings. And then if I look at next year, they're going to grow about 7-8%. So maybe about 21 to 22 times next year earnings. This company's expensive, but you're paying for the stability. This is not one you're going to get overly rich on, but I feel like 10 years down the line, my yield on cost from that 3.1% starting dividend will be significantly higher. I think the company will continue to experience capital appreciation as long as they continue to execute as well as they have in the past in the beverage category. And I just think it's a good staple to have in your portfolio. So looking to build this one up. Right now, I think I have about 110 shares, looking to get it to about 150 shares by the end of July. So those are the 3 US dividend stocks I'm buying in July. If you like this type of content, be sure to subscribe to the channel. Really appreciate it if you made it all the way through the video. If you did, let me know in the comments. Not many people do, so I do really appreciate it. Would love to hear from you. And if you haven't yet, be sure to like the video for the YouTube algorithm. Really does help channels like mine, and I do appreciate it a lot. Thanks for stopping by, and I'll see you guys in the next